Hey guys, welcome back. We're here for episode 3 of the Surrey Road Finance podcast. Today we're joined by Vish. Thanks for coming on board today, mate.
It's good to be here.
Always good to have a chat, so looking forward to this one. So today we're going to be talking about property investment. Over the last few years there's been a significant rise in the Perth property market and a lot of investment activity. So we're going to talk about how to structure investment loans and especially for existing homeowners. So let's get into it. Now, Vish, before we get into the nitty-gritty of investment loans, let's first talk about how a client can actually afford an investment property. Do you want to go through the financial obligations and what needs to be considered when buying an investment property? So starting with how much of a deposit is required?
Yeah, it's obviously topical from our initial or first podcast episode with deposits, but as always, the gold standard is about a 20% deposit plus costs. However, for investment properties specifically, it can be anywhere between, you can have as little as a 10% deposit effectively, but that will come with a component of lender's mortgage insurance.
Yep. Yeah, we discussed that a few weeks back, didn't we?
Yeah.
In terms of the holding costs, what are the main things to consider there?
So you've obviously got the servicing of the loan, so your interest repayments and interest component. You've got your property management fees if you decide to engage with the property manager. You've got your, insurance. If you're in a strata property, you've got your strata fees. And then there's, of course, the ongoing repairs and maintenance that you've got to factor in as well.
Yeah, important to have a good property manager to assist with all of that. In terms of, the rental income, once again, the property manager will help there. Hopefully there's enough there to cover a portion of those holding costs, but, sometimes it's positive, sometimes it's negative. What do we usually see for different property types?
Yeah, so it is really important, irrespective of property type, to have some sort of a buffer. Yes, you will be receiving an income, but, depending on certain points in time, like you've correctly pointed out, you might be in a surplus or you might be in a deficit. So you want to have a buffer for if the rental prices go down, if the property becomes vacant, your tenant gives you notice and leaves. And also you just never know when something might go wrong. The air conditioning might blow up or, the hot water system might give way. So it is really important to have buffers in place.
What is a typical buffer for a first-time investor then?
Oh, we typically, it is really hard to say exactly what it is. It'll depend on the property value, how old the property is. But I think as a real rough gauge, $5,000 to $10,000 is always a good idea.
So we've spoken a bit about the obligations and your holding costs. Now it's more so the asset selection. What are the key things that we want to look at, for why people might buy an investment property?
Yeah, so typically speaking, people buy an investment property for one of two reasons. In their investment journey, and that's typically either for capital growth or for cash flow. Now, and how you get to that point and is two different questions really.
Now, from a cash flow point of view, as you said, negotiating the rent will be critical for that. So in terms of the property manager, that's something that you noted out before. How are people going to know what's better for them, cash flow or capital growth?
Yeah, so I guess I'll touch on that and in terms a little bit more. So cash flow, you probably got investors who are a little bit further down their investment or wealth creation journey, if you want to call it that, where they might be slowing down at work, proceeding towards retirement, and actually earning an income or receiving an income from their assets is a more important thing. Whereas capital growth might be someone a little bit earlier on in their journey where they're looking to buy an asset that's going to grow in value, which they can then utilize that value to, purchase other properties or, invest it in other things, upgrade their home, shares, whatever the case is. So yeah, there's two schools of thought and it just depends on the person.
Yeah. And I guess the typical investor, if they want to buy multiple properties, the capital growth is going to be key for them then, isn't it?
Yeah, exactly. And just on that's probably important to note that typically speaking, this is just based on historical data. Houses or landed properties with a fair amount of land are typically the ones that provide greater capital growth over time. And that's for the simple philosophy that it's land that appreciates and buildings depreciate. If you look at asset classes like apartments, for example, you may not pay as much for them. However, especially in a tight rental market like we have been over the last couple of years, you may be receiving a pretty decent rental yield where you're actually positively geared. So you're getting income into your pocket.
Yeah, it all depends on the client situation. Yeah, well,
Exactly
said.
right.
In terms of, I guess, while we're here, structuring investment loans. So, what's the right way to do it? What are the key things to consider when we're setting up our investor loans?
So debt structuring is really, really important when it comes to investment loans. So what we typically do, and we're talking about someone in this case that has their home and then they're looking to buy an investment property. So, assuming as we said, prices have gone up in Perth, so utilizing that equity to go again. So typically, how we structure them is we would create a new loan split against their owner-occupied home for the value of a 20% deposit plus all costs, stamp duty, bank fees and whatnot, for their proposed purchase price. Like I said, it's a completely separate loan split to their home loan. And then you proceed to borrow 80% of the property value that you're purchasing. And we always structure it that way.
Do you just want to touch on, I guess, with the valuations for their existing home? Like, there's a few ways in which you can determine the best way to access that equity. Like, is there going to be different valuation types? We're going to send someone out there. What's important to consider?
Yeah, so it's as time and technology has moved on over the past 5 to 10 years, especially in our sector, valuation systems between banks can be quite different. One bank may value your property at $1 million and another may value it at 1.2 or 1.3. And that sounds rogue, but that's the reality of it. So depending on what bank valuation you get at one bank, it might actually give you the ability to access more equity, which then potentially changes your purchase price as well on the new investment. So I guess that's where it's really important to look at all of your options, but it really still just comes back to the structure, making sure that it's a separate loan split and then borrowing 80%.
So you've made the importance on the structure. So cross-collateralisation, just want to make a note on that, and I guess the bad thing about it and why we try to avoid it.
Yeah, so doing it in the way that we've just discussed is avoiding cross-collateralisation. Now, cross-collateralisation is where you actually just utilise the equity that you've got in your existing home and the bank funds you 100% of your new property purchase, but they actually link both properties. Now, in the structure that we've just suggested, where you access the equity against your owner-occupied home and you create a separate loan split and then borrow the 80%, you're actually keeping both of your properties completely separate. And the importance of that is that, especially if you're looking to build a portfolio over time, you want to ensure that you've always got control over your portfolio, not the bank. So to give you an example, if property A, decreases in value and then you decide to sell property B, if they were cross-collateralized, the bank actually has the ability to tell you to use proceeds of sale to pay down debt so that they're comfortable with their risk position. Whereas if they're completely separate, the bank can't do anything. Each property is taken on its own merit and you basically get to decide what you want to do at any given point in time.
Yeah, and we've seen that a few instances, isn't it? When a client's come to us, they've been to a bank direct or with another broker and he's crossed, and that paying down of debt or the proceeds of sale has restricted them in doing their next stage. So it's important to set it up.
Exactly, and just losing access to cash that you thought you might have, you're always better off not cross-collateralizing.
Now, I guess onto setting up the loan the right way, the tax implications, of an investment property. What are the few things that we need to consider there? So what might the implications be? Yeah,
so this is probably really important to know that all investment loans or any investment loans, it's for the purpose of investment. There is an element of tax deductibility. Now, we will always liaise with our clients as well as their accountants to make sure that the strategy is effective. So going back to what we were saying before as well with the debt structuring, when you've got your second loan split that we've just created against your owner-occupied home, by the letter of the law, even though it's secured against your owner-occupied home, because it was used for the purpose of helping you buy your investment, that debt's also technically tax deductible. Now, it just keeps things really clear from a tax perspective when you do your taxes. What was this loan for? investment. Okay, what interest did I pay? And then accordingly, the implications from a tax perspective is that it should actually be beneficial. But again, that's something that you'll work through with your accountant come tax time.
So we'll liaise directly with the client's accountant as well to confirm the structure's been set up correctly and what's been used for what purpose.
Exactly right. prior to actually lodging any applications, when you look at the strategy, not just immediately to purchase a property, but longer term, it's important to have that conversation with the client and their accountant to make sure everyone's on the same page.
How might an investment loan differ to a normal home loan? So what's going to be the main differences between the two? Is it rate? Is it, the fees?
To be honest with you, they're probably pretty similar by definition. I would say the major difference is rate. And even then, in the last little period, the gap is actually not that different. So as a real rough gauge, I would say the difference between investment loans and owner-occupied loans is anywhere between 30 to 40 basis points.
Will the lenders assess them slightly differently, or they assess the same?
Yeah, so servicing is obviously a topical thing, as always, in what we do. Now, investment loans are typically more favourable. And I'm not sure that's the right word, but they're looked at, or they boost your capacity effectively. So because the debt is for the purpose of purchasing an investment property, the bank will apply negative gearing or tax deductibility on that debt, and not forgetting the fact that, even though you may not have bought it yet, there is a proposed rental income that will come from that asset, and the bank will take that into their calculations. So it's more favourable than an owner-occupied loan from a capacity point of view, that's for sure.
We touched on, I guess, your financial obligations, your holding costs when owning an investment property. Do we typically see investment interest-only loans then for investor clients, or is it a bit of a mix?
Yeah, again, taking it back to our strategy with the accountant and the client, each client's going to be slightly different. Some people may be really focused on paying down debt, which is completely fine. Paying down debt is not a bad thing. However, typically speaking, if someone's got a fair amount of owner-occupied debt, they might be more likely to go on in the interest only for the investment debt, just so that you can focus on paying down your home where you actually get no tax benefits. Whereas if you can maximize your investment debt, you maximize your tax deductibility as well. So interest-only loans are pretty popular with investment loans, but again, everyone's slightly different.
Slightly different. That's probably going to be similar for offset accounts then, whether it's worthwhile being on an investment loan or just better to offset your owner-occupied debt.
Exactly right. So, typically speaking, you should always offset your owner-occupied debt for the same reasons that I just mentioned with tax benefits. Now, you might have a $1 million owner-occupied loan, for example, and if you're not really anywhere near close to having that loan fully offset, meaning to say having $1 million in cash, then there probably isn't much point in having an offset account against an investment loan and putting money in there. However, that being said, a lot of the banking products nowadays come in packages, so you kind of get offset accounts included in your package, and a lot of clients actually like to have an offset account against their investment loan, just so that they can have the rent paid in there, they have all of their expenses coming out of there, so it's really easy management for them, and they can also keep their cash buffer in there as well, like we were saying before.
Yep. Preference, how people like to manage accounts. Some people like having 20 accounts, some only wants, one or two. So
exactly right. And it also just come down to fees as well. If people want to minimize fees, then, typically an offset account will come with some level of fee. But again, that's a discussion that we'll have with the client.
Yeah, great. A few great points covered there. We're just about out of time. If you could give any investor one tip, what would it be?
I'm going to go the easy way out here and probably combine a few points. I think the main thing is debt structuring. We've really focused on the importance of that, and it's to maximize your tax effectiveness. It's to ensure that you know exactly what's going on, and to give you control of your growing portfolio. So how you set it up at the start, especially for your first one, really will determine your ability to keep going.
Yeah, great. Well, that's all we have time for. Thanks for joining us, Vish. Appreciate it. Thanks everyone for watching. We'll see you next time.
No worries. Cheers.